Hey everyone, it's Alec Crawford, your host for the AI Risk Reward podcast. And today our special guest is Jon Kutsmeda. As CEO and co-creator of LendZen.com, Jon brings nearly 20 years of experience in residential mortgage lending to the world of fintech and AI. Welcome, Jon.
Hey, Alec, I appreciate you having me on. Thank you.
Yeah, and thanks for doing this from the land of Oz. It's a little early there, apparently, but more exciting. You're one of the few people I know who kind of grew up near Philly and then ended up moving to Hawaii, which is many people's dream, I'm sure. So tell us a little bit about that.
Yeah, I think I've always had that entrepreneurial spirit, and for whatever reason, it became an idea to move out to tropical paradise. I think a lot of people after they finish university and they're battling with what their career decision or next career move should be. I was definitely in that space and decided to initially take a short sabbatical to maybe figure some things out, and the rest is history. I mean, one of the things that 20 years ago, especially with Hawaii, is there's not many career opportunities. So you're forced into kind of making your own way, and as an entrepreneur, it really helped me double down on some of those aspirations.
Yeah, that's called burning the boats, Jon, right? Hey, guess I'm an entrepreneur because I got no other choice. And you've been in the mortgage market for a long time. I mean, I hesitate to tell you how long I've been in the mortgage market since the 1980s. But obviously, look, industry practices have changed. And obviously, we went through the whole kind of ninja loans and Fannie and Freddie blow up and all that kind of stuff. But just curious from your perspective on the inside looking out, like what industry practices pre GFC did you witness that you would criticize today? And how did those experiences shape your professional ethics today and really lead to the creation of your company?
Yeah, I fell into the mortgage industry in 2005. As I was saying, there isn't a lot of opportunities in Hawaii, particularly at that time. I had a friend in sales open up a interview opportunity, and I decided to pursue it. So I've been through all that. I was, doing subprime loans, and I saw what that environment was like. I think Dodd-Frank and the reactions to that had both positives and negatives. I think ultimately, and you speak of your experience in the mortgage industry and banking going back to the 80s, I think what a lot of people don't understand is there was a big sea change in the late 90s when you had the GSCs, Fannie Mae and Freddie Mac come out. And one of the reasons the lobbying behind those was to standardize interest rates. So if you're in a small market in the Midwest, you're not getting stuck with really, really high interest rates for residential homes versus a more densely populated market where liquidity and credit's flowing more easily. That was the initial intention. And as that idea grew, it ultimately standardized the market. And today, we're talking that's an idea in a model that's 30 years old. Everyone in the industry, for the most part, if you're talking about a conforming loan, which meets very specific conventional standards, FHFA, loan limit requirements, and a number of like matrix driven criteria, like what's your loan to value compared with your credit score, that's going to have a certain type of risk price adjustment on your loan. But a lot of people don't realize this is across the board. So it doesn't really matter where you go. Your local bank, credit union isn't underwriting you because they know you or they have a car loan or checking account with you. They're underwriting based on these national standards. And for the most part, the entire industry is just a fee driven business model that has been bloated and really over the top when it comes to the types of fees that are being collected. It's an entirely different conversation, but very, very similar to the one you're seeing in real estate. The real estate agents just had this big class action lawsuit, or at least the board of realtors did. And there's still this, like, I think, cognitive dissonance about what's happening with tech, what's happening in service-based industries everywhere. I think if you didn't drive a taxi for a living, you looked at Uber and you were very grateful for the optionality and the fee compression that brought into that space initially. But anyone who's in another service-based industry, especially in real estate and in mortgages, acts like that can't happen to us. But those fees are unnecessary considering the automation that has existed for 20 some years. These loans are being run through a software called, in the case of Fannie Mae, desktop underwriter, that's making a algorithmic underwriting decision. And I think the tools that are now available, the AI that can read documentation, AI agents that can make relatively critical decisions. I think that the process to go from a consumer wanting to shop for a mortgage and then apply for it can ultimately be condensed down to a handful of steps and a handful of minutes that doesn't need people involved. And the people are the one charging the fees and making home ownership 6 to 12% more expensive than it needs to be.
Yeah, I mean, look, punchline is there are 300,000 people in the US employed in the mortgage lending industry, according to the Department of Labor. Yeah, what do you think happens to employment there in the next decade or so?
Well, in addition to the cognitive dissonance about people willing to accept that their livelihood is under threat, it also brings in this existential crisis because, there's that question that you just proposed, what happens? What do we do next? The political environment right now is very hostile. It's very volatile, but we're not even right now looking at the impact that technology is going to have on GDP globally, as well as employment globally. But here in the United States, I don't think anyone really has an answer for that. And I think if you sit around a coffee table and discuss it openly, things like universal based income do come to mind. But at the same time, I think one of the things that AI, whether it's in real estate, mortgage, or really any of these service based businesses, one of the things I think AI hopefully will allow is people to focus more on passions and talents versus just chasing that paycheck.
Yeah, that totally makes sense. So, turning back to Fannie Mae and Freddie Mac, obviously they've been reformed a lot since the financial crisis. They're still in receivership. Like, any predictions of what happens there? And is their continued receivership signal deeper systemic issues, or would coming out of that, would that help the mortgage market? What are your thoughts there?
Yeah, well, there'll probably be people in the comments that say it's in conservatorship, not receivership. I
Oh,
think
sure.
it's
Yeah, conservatorship. You're right. Yeah, yeah.
six of one, half dozen of the other. It's in the hands of the government, and there has been talk, of it being restructured in some way so it can go public again. I just don't think it's realistic because it's still funding. Let's just pick an arbitrary percentage that's somewhat accurate. Let's say 80% of mortgages are going into these MBS pools that are being purchased by Fannie, Freddie, and Ginnie Mae. To take these out of the situation that they're in and make them public again, I think is probably more so about providing exit liquidity to people who hold shares in those companies, because I think we would just go right back to this implicit guarantee that got them in trouble in 2006 because everyone more or less felt like the government was a backstop. I think
Yeah.
now it would be more understood that they're a backstop, but maybe not necessarily the risk structure of how these loans are being done isn't the same as 2006. So I don't think it's as big of a concern that some sort of crisis unfolds. But I think you create a situation where the biggest problem we've had the last 3 years with mortgage rates has been a lack of liquidity in the bond market. The Federal Reserve came in, the Fed raising and lowering their overnight lending rate has nothing to do with mortgage rates. The only way they can directly impact mortgage rates is what's called open market operations, where they're coming in and using things like quantitative easing to buy bonds, which pushes the price of bonds up and the cost of rates down. They did that excessively in 2020 and 2021. That's why we now have this lock-in effect. Everyone's sitting at, 60% of the population has a rate of 4% or lower, and there's probably half that have 3%. So because of that, the last couple years, as inflation became a big factor, holding bonds was not attractive for investors as inflation was unknown. Massive liquidity scare in the bond market, not just government treasuries, but especially mortgage-backed securities. So if you take the entity that is the backstop of the mortgage market and expect the public market to be the one providing liquidity to that entity, and an entity that's ultimately driven by what the bond market is doing, you're going to have massive volatility that could ultimately seize up the market. So it's not just as Fannie or Freddie a viable business, It's what happens when investors no longer want to be buying mortgage-backed securities because other underlying economic factors like inflation push them into other asset classes.
Yeah, much broader question. Yeah, so I got to say, if I have to listen to one more commercial around home title lock, triple lock, I don't know if you're getting those in Hawaii, but they're here all the time. I'm going to be ill. I'm curious, like, how easy is it to move a home title electronically now? Or are there certain parts of the country that's prevalent in and others not? I'm sure some of it's got to be still like on paper and, county courthouse or something.
Yeah, I think that's also part of this streamlining and automation that massively disrupts this industry. And I recently made a post on X, Twitter. My handle is Jon Kutsmeda, and in that post, I talked about one of the things that is interesting is for the last call 20 years, the bears or people who kind of have this like trauma from 2006 were constantly waiting for that next crash in the housing market, and home prices are up 400%. And we tend to hold on to those experiences thinking they're going to happen again. And what happened in 2006 and 9 was you had a lot of people doing, whether you want to say liar loans, ninja loans, but a lot of that was associated around adjustable rate mortgages. And when those mortgages adjusted higher, people couldn't service the debt. What's ironic now is we're starting to see stress in certain markets because the thing that they never expected to be variable is now jumping on them, which is home insurance and HOA
Mm,
costs. So
yeah, good point.
so I proposed the question: is this the black swan or the thing that we need to be talking about? And someone commented on that slightly off topic, saying, "Well, can't we just transfer the mortgage? Like, why can't somebody take their rate with them?" And I think
Yeah.
it's a big misunderstanding of how
Yeah, no,
complex.
I was talking about titles, not transferring your mortgage. Just curious. Like, so when you sell a house, can you transfer the title electronically and easily, or it's still like going to a county courthouse, needs to get stamped, it's on paper kind of thing? That was the question, really.
Yeah, so that's a city and county individual thing, and I think eventually that gets streamlined. And
Mhm.
boy, will that make life very very interesting and convenient for a lot of people because things will be happening at a much more streamlined level. But if we take a step back and we say, okay, real estate agents should be redundant almost at this point. Loan originators are very close to getting to that point. So you're automatically at that stage potentially freeing up 6 to 12% of liquidity because the seller is going to end up eating that 6% between the two agents. Loan originators are charging somewhere between 2 to 3 points, which is absurd. And there's all these other additional costs, one of which is title insurance. And title insurance becomes redundant.
Oh
And these
yeah.
huge
Yeah.
companies like Fidelity and First American are no longer necessary because if you're using something that's immutable like a blockchain and everything is electronic and digital, there's no question about whether that title is clear.
Yeah.
I mean, and that eliminates another aspect to this that is a huge piece of cost or bloat in the industry.
Yeah. I think the title insurance is gonna be around for a while because the lenders are gonna require it's just this big kind of like circle of distrust, which ain't going away anytime soon. But to switch gears to AI, we talked about AI a bunch earlier. So, interesting thing going on at the state level. So, the Colorado AI Act was just kicked off in February of this year, and it requires transparency in AI driven consumer lending decisions and the ability for consumers to request a human review if the AI turns them down. So, in your opinion, how transparent should these AI lending algorithms for consumers be in the mortgage process?
Yeah, I'm not super familiar with that particular legislation. We are
Mhm.
licensed in Colorado, so I'll definitely look into
You'll be
that.
familiar
But
with it soon.
yeah, I think I don't have a real visceral reaction to it because we're still going to apply checks and balances. I think the way we look at AI in the mortgage process, there's really two initial steps in our view. One, I think the customers do not understand actually how to shop for a mortgage. And we talked about it earlier that everything is standardized. No one is deciding interest rates individually. And
Mhm.
so what most people don't understand is that when they're shopping for a mortgage, it's not the rate that they're shopping for, it's the cost of that rate. And if you really want to get a fair, honest comparison, what you need to be doing is getting estimates for the same exact rate on the same exact day, because the bond market's driving the cost of rates, and that changes every single day. And so if you get an estimate from one company and then a week later get an estimate from
Yeah,
another for the same rate, it's
totally
apples and
different.
oranges,
Yep. Yeah,
because the
exactly.
cost of that rate is going to have fluctuated. At the same time, what ends up causing a lot of confusion because people think they're shopping for rate is you'll kind of have this bait and switch, or one lender might find out that you're getting a quote for a 6.5%. Someone else will come in with a 6.25. Now that 6.25 is going to cost more, but
Yeah,
because
just
it's a
more
six and a quarter,
points or whatever. Yeah, no, I totally get it.
yeah, and
Yeah.
so the consumer thinks they're getting a better deal, but if they went back to the original quote or the original lender and got that 6.25 on the same day, then they'd be able to make this transparent fee comparison. So for us, I think that's the biggest point of failure for consumers. Even if you can get a loan through AI or go through the approval process in a relatively streamlined, automatic manner, you're still going to make a bad decision because the lenders aren't providing transparent fee quotes and transparent interest rate information up front until you end up giving up a ton of personal information. And then you just become a lead or a prospect. So with LendZen.com, what we've done is we've opened all that up. So we democratized the same way you would think a Zillow or Redfin did with the real estate listing data. We've made interest rates public. It's anonymous. You can go in there, shop around, and we've created algorithms that ultimately help people make an instant decision on what rate they should choose based on a number of personal preferences or dynamics. One of the most important is timeline. Like if you think you're going to be in the
Yeah.
home for a certain amount of time, that's going to determine what rate you get. But more importantly, if you think rates are going to improve because the bond market's going to improve, you also want to keep that in mind when you're making a rate decision. So that's number one. The second piece is the actual approval process. And for most people, what they're looking for is a pre-approval. They want to go shopping and they want to know how much they can actually afford. And I think AI automation is going to provide that service, streamline that process wonderfully, because it's not a guarantee to lend. No pre-approval is. And so I think once you get to the point where you're talking about preparing documentation and doing title and potentially funding a loan, I think you still need human checks and balances. Now that could change very quickly in the next 18 months, but right now I don't think anyone in the finance world should be relying entirely on what AI is deciding. But initially, at an algorithmic level, I could see where it makes sense to put that in place. And if someone came through our portal, applied for a loan, and we saw a denial, one of the first things we would do is look in and try to understand why and make sure it wasn't, delivered incorrectly.
Right. Or just an error, someone left a zero off their salary or whatever. So shifting to the advice section, what's a great piece of advice you got in the past that you'd like to share with the audience?
As far as
Anything,
entrepreneur,
anything, be an entrepreneur, anything, life advice,
I
anything.
I, th- I think one of the things that resonates with me right now, particularly because we're in the trenches, pushing the progress forward in a place where there's a lot of incumbents who don't want things to change because they're making a lot of money. At the same time, everyone else who's in that trench is very, very competitive. It's a very, very competitive place. If you just look at the handful of most prominent AI language models or LLMs, you're talking the open AIs that we just had Grok released. You've got, Gemini, Llama. There's just so much competition, even at the highest level where there's billions of dollars being poured in. You trickle down a few steps and it's a very, very competitive environment. I think one of the things I like to keep in mind, and it might have even been a Steve Jobs quote, was, so much of your success depends on how long you can stay in the fight. And I think for anyone who's thinking about being an entrepreneur or has some sort of passion that they want to pursue, really any kind of goal in mind, just understand that sometimes it's partly just about outlasting the other guy, right?
Yeah,
Being
that
being
sounds more
able to,
like Jensen Wong. By the way,
yeah. I mean,
yeah,
that's
than Steve Jobs, who probably should have gotten treated for his pancreatic cancer sooner. Um, And look, so yeah, and shifting back to advice, what about advice for kind of founders who are focusing on AI now? Any advice there?
I think the first thing with any founder in any business doesn't necessarily have to be AI. Is I think there's a difference between being a founder, entrepreneur, and a small business owner. And I think you really have to ask yourself, can your business scale, and to what type of market cap? Like, what really is the economic potential of your idea? And maybe, as much as it hurts the ego, realize that maybe you're a small business owner and not necessarily in this startup founder. Like, I don't think it's fair that everyone just slaps the word founder on anything because they're starting a business. And I think small businesses oftentimes are way better models than the founder startup model, because so much of the founder startup model is cash burn until you've built that revenue base. And I think the Facebooks of the world have really distorted reality in terms of how many of those so-called unicorns can actually pull it off. And when you think about service-based businesses and businesses that we could argue don't necessarily scale because of the need for human capital, are really successful businesses. Whether it's someone who has a franchise of small coffee shops, or someone who's in landscaping or maintenance. I mean,
Yeah,
these are really, really great businesses. And I don't think it makes sense to call those types of owners founders. And I think
yeah.
separating the two and understanding if your business can scale or not is going to save you a lot of grief.
Absolutely. Basically, ask your friendly neighborhood venture capitalist if they would fund you, and if the answer is no, then you are not a founder. So, give us some accounts you follow on X, because I know that's like one of your main sources of info, John.
Yeah, I think X is a great, for me. It started out of the financial crisis. So it was a small place at the time. It was definitely a lot of users, but it was definitely not the beehive that it is now. And I think you could go there, get insights from prominent people in finance and geopolitics, and it wasn't a lot of the bravado and toxic interactions that you have now. But still, as the platform has matured and you've had different types of personalities come into the space, I think one of the things that's so special about X and what goes on there is you're going to be tested and your ideas are going to be tested. And so you can't just go in and say something lazy without paying for it. And I think it's a great place to test your ideas, test um, public opinion, and really kind of see, are you thinking about this correctly, and ultimately, are you as smart as you think you are? And I think X is profound for that. Doing YouTube videos like you are here, and some of the other platforms that focus on video like TikTok and Instagram, it's all the same handle for me. It's Jon Kutsmeda, and most certainly I'll be producing a lot more of that content in the coming weeks and months. But a lot of the deep thought experiments, I ultimately end up sharing on X.
Awesome. That sounds great. So we head into our last segment, which is called underrated or overrated. So it's a lightning round where I mention something and you tell the audience whether you think it's underrated or overrated and why. We will give you a couple passes in terms of fairly rated or something, but we're going to kick it off with learning to surf as an adult, underrated or overrated.
Oh, I think surfing is very underrated. Learning to surf as an adult is a do not try unless you're really, really committed. It's pure misery. So I guess I would say surfing as an adult, or learning how to surf as an adult, is massively, massively overrated. It is pure misery.
Got you covered. And you're calling from Australia, like the surfing capital of the world. Uh, Pearl Harbor historic tours, underrated or overrated?
What's really ironic is I lived in Hawaii for about 15 years before I started traveling to different places. Now headquartered in Puerto Rico, and I spent a bunch of time in Sydney, Australia. The company is still based in Honolulu. But in that 15-year period, I never once went to Pearl Harbor. I'm not a tourist trap or tourist experienced type of person. I'm more off the beaten path type of experiences. So I'm going to have to pass on that one because I have no idea. But I think overall, if we're talking about Oahu and experiences to be had, I would say Pearl Harbor is overrated.
Uh, how about Ginnie Mae? Underrated or overrated, given that they only have a team of 150 people?
Well, Ginnie Mae is Fannie and Freddie get a lot of the attention, but Ginnie Mae is just as significant. And Ginnie Mae is more of the government backed loans, which is USDA, FHA, and VA. And VA loan is a great benefit for people who have served or currently serving. FHA, ironically, gets bundled into those same securities, and it'll be interesting to see how that dynamic unfolds because the FHA loan basically became the new subprime. There are Fannie loan products, and it doesn't necessarily have to be first time home buyer. A lot of things that coin loan programs as first time home buyer often it's just a way to market it. You don't necessarily have to be a first time home buyer to leverage these programs, but conforming or conventional loans for Fannie have a minimum down payment of 3%, which is actually less than FHA, which is 3.5%. Those loans will both have monthly mortgage insurance. Anytime you do a loan where the down payment is less than 20% or the LTV is higher than 80, you're going to have to pay mortgage insurance on a monthly basis to reduce the risk for the lender. With FHA, you also have to pay upfront mortgage insurance. So generally, FHA doesn't really pen out as well as the Fannie 3% option. The reason why a lot of people do FHA, the Ginnie Mae mortgage pools are priced higher because there's more guarantees there. Therefore, those rates are less expensive. But also the other thing is the credit score requirements on a conventional loan are much higher than FHA. FHA almost will give anybody a loan if other criteria are met. And the credit scores can go in the 500s, which is basically the worst type of borrower to lend to because they're almost guaranteeing at some point some sort of hardship or default. It might not be the mortgage, but their credit score is already indicative of that going on underneath. So the fact that these government-backed mortgage securities at Ginnie Mae, which have bundled FHA and VA together, have what many would consider somewhat toxic mortgage. Now, it's not like the subprime, but anyone who has a bit of a doom and gloom attitude about the housing market is very, very closely monitoring and putting emphasis on FHA and some of the weakness or foreclosures we're starting to see in that market. So I think on one hand, Ginnie Mae is extremely underrated because of the value it provides in one segment of the market, but it's also extremely overrated because I think there is this underlying risk in the FHA market that is not fully understood yet.
Got it. Okay, back to our lightning round. Fishing for tuna, underrated or overrated?
Underrated,
Hawaiian shaved ice, underrated or overrated?
overrated.
Yeah, I mean it's funny though. It's not as good anywhere else. Hawaii's got it
You got
nailed.
to try it, but it's
You got to try it. It's
definitely,
for
yeah,
tourists. Uh, Louis Ranieri, often credited with pioneering the securitization of mortgages, underrated or overrated?
I think massively underrated.
Yeah, kind of like no one knows his name, right? Hawaiian poke bowls, underrated or overrated?
In Hawaii, I think they're underrated. Everywhere else, I think they're massively overrated.
Yeah, they're pretty good there. Going on a whale watch in Hawaii, underrated or overrated?
I think that's pretty neutral. I think you're not going to be guaranteed to see whales, but anytime you can get out on a boat in the open Pacific Ocean, I think that's an experience worth doing.
And last but not least, the movie The Big Short, underrated or overrated?
Um, I think it's I think it's underrated in the sense of what it's done to help people understand what happened in 2009. I didn't realize being frontline. It was so clear and granular to me all the things that were involved in that, but the average person didn't really fully understand it, particularly from the standpoint of how the government bailed out the bankers that were directly responsible for it. And I think that really opened a lot of people's eyes. So underrated.
Excellent. John, thank you for coming on the show. This has been Jon Kutsmeda, CEO and co-creator of LendZen.com. You can find more information in the show notes. John, thanks for coming on the show.
Hey, Alec, I appreciate your time and thank you for the lightning round there at the end.
Awesome.